The S&P 500 is up 36% over the last year, but a stock that has consistently beaten the market is Meta Platforms Inc., ticker symbol Meta, otherwise known as Facebook, and it is currently trading at $591 a share. Over the last year, it is up 85%, and over the last 5 years, up almost 209%, which is easily beating the market. What we're going to be doing today is looking at my automated stock valuation spreadsheet to see if Meta is a buy or a sell using the discounted free cash flow model, comparable company model, and the Ben Graham formula for intrinsic value. So as I said, stock is up 500%. It was trading at around about $400, we'll say, and then had a big drop off. It was dropped 76%. It was trading at $90 a share. The stock was dead. Thing was looking bad, and since then it has gone up almost over 500% to its all-time high. So let's have a look at my automated stock valuation spreadsheet. If you're interested, check out my Patreon. I'll talk about them all later. But if you type in the ticker Meta, this will load up all the latest company financial data so we can have a look. $591 a share, 1.5 trillion in market cap, making it one of the largest companies in the world. A PE of 27.88, which you may know that is lower than the current market average, which is 30.3. Earnings per share, $21.20 a share. Beta of 1.22, meaning it's slightly more volatile than the market. And a target price of $640 a share. So analysts do think it is a buy. Recently started paying a dividend, 0.35%, meaning they will give you $2.07 per share for every year that you own Meta. It's a very safe dividend. They pay around $4.5 billion in terms of free cash flow ratio and net income payout ratio, 11 and 8% respectively. Ex-dividend date is the 16th of December, so buy your shares before then if you want to get paid your quarterly dividend. So let's get straight into the revenue here. All-time highs, $155 billion. This is the trailing 12 months. Constantly growing. They had a bit of a dip in 22, but have been managed to grow it since then. This is what you like to see. Net income, similar story. Bit of a dip in 22, 23 billion, 55.54 billion, all-time highs for Meta stock. So that is looking very, very good as well. Free cash flow is a similar story. Not quite, 40.5 billion, down from the all-time highs in 2023 of 43.58. If we were to look at the operating cash flow versus capex, this is what free cash flow is, operating cash flow minus capex. We can see that capex has increased. Operating cash flow is up as well, yes, but capex has increased, which is why the free cash flow is down. But operating cash flow is still growing and growing and growing, which is excellent to see. They are actually buying back shares. This started in 2017, and they've been rewarding shareholders by buying back the shares. So let's have a look at the discounted free cash flow model. This is a way of valuing companies, looking at their future free cash flows and discounting them to today's value. So currently it gives us a price of $314 a share. Let's look at the numbers and see if we agree with it. So we're expecting revenue estimates of 172 and 190 billion. Let's see what analysts are saying, and then let's see what they say for the 5-year growth rate. 163 and 186, and they're expecting 17%. Wow, for every year. So, was that 96? I wish I had any form of memory. That's what happens when you speak and talk at the same time. Sorry. 163 and 186. So we're probably a bit more on the bullish side. We'll keep that as it is. In fact, yeah, we'll keep it as it is. Net income margins, looks like they're increasing. We're going to take an average of these 2 years, which would bring us to 32.5. And I think it's going to be more fair if we take an average of these 3 years here. So 91%. We'll have a look and see, and this gives us $400 a share. So yes, overvalued according to the discounted free cash flow model, but the price is in the ballpark, which is very good. You don't normally see this for these sort of fast-growing tech companies. A lot of the dividend discount models really don't like it, but you know, it's I mean, obviously 30% overvalued at the minute, but I think it kind of shows that this is a free cash flow generating machine, realistically. So let's have a look at the Ben Graham formula for intrinsic value. This looks at earnings per share, P of a non-growth company, and the AAA bond yield, and the corporate bond yield, which is currently 4.95%. And I believe we said that analysts are expecting this to grow at around 17% over the next 5 years or per annum. So not a buy. Interestingly, again, fair value of $480 a share and a grain price of $370. So, you know, it's slightly overvalued according to this. Interestingly, very close to the discount free cash flow model. We can't look at the dividend discount model yet, but they have started paying a dividend. So if I'm still doing videos and you guys are still watching me, in 5 years we'll be able to use the dividend discount model. But finally, we're going to look at the comparable company model. This is a way of valuing companies, looking at similar companies of similar sizes, industries, and we'll look at revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, PEG, Peter Lynch's price to earnings growth, EV to revenue, EV to EBITDA, PE, and forward PE. So companies that immediately jump out at me are Google. I don't know why I said Goog so weird. It's because it's ticker symbol Goog, G-O-O-G. And what this will do is it'll load the company data and we can have a compare. Another one I suppose that I think, I mean, these companies are different, but still I think it's kind of in the same region. We'll look at the sort of the FANG style companies, which is obviously... and we'll go for Apple as well for now. And this will load up all the latest company financials. And as I said, we can see. So Meta is the smallest, 1.5 trillion compared to Google's 2, Microsoft's just shy of 3, and Apple's 3.4 trillion. Least revenue, less revenue. Anyway, lowest revenue we'll go with 155 billion. Compared to Microsoft's 240, Google's 340, and Microsoft's 390. Growth rate is still the fastest growing, 19%, which is excellent to see. EBITDA, 80 billion. Net income, 55 billion. Lowest net income, but second highest profit margins. Only Microsoft is close. Apple and Google in the 24 to 28 range. Meta and Microsoft 36 and 37. Price to sale, second highest, 6.2. Market average is around 3. Price to book, second lowest again. Market average is around about 5.2. PEG, though, Peter Lynch's price to earnings growth, it's the lowest, and also it is under 1, which would mean that this is undervalued by the metric. So that is excellent to see. EV to revenue, second lowest. EV to EBITDA, second lowest. PE, second lowest. And forward PE, second lowest. Gives us prices anywhere between $540 and $650 a share, giving sort of an average of about $607.95. So it is a buy according to the comparable company model if you were to compare against Google, Microsoft, and Apple. Just before quickly as well, the FANG companies, well, I suppose they have to change the name now. Is the Mang? No. Oh, well, you have to change the name now. I don't know how you can change it. But anyway, Facebook, Amazon, Apple, Netflix, and Google. We'll switch out Microsoft there for... we'll do Netflix, which is Netflix, NTFX, I believe. No, what's Netflix? Netflix share price. It is, oh my god. Netflix. Ugh. Close but no cigar. Let's see what this brings us in terms of the price. So actually that would say it's slightly overvalued. The reason for this is because the EV to revenue and EV to EBITDA is lower, but you can see it loves it on the PE ratio there. So still about fairly valued if you include Netflix instead of Microsoft, but I think I prefer Microsoft looking at the stock. So yeah, discounted free cash flow model says it is slightly overvalued. Ben Graham model, or formula, sorry, thinks it's about the same, but comparable company model does say it's a buy, comparing it to Google, Microsoft, and Apple. Just finally as well, as I said, we compared the market over those similar times. Year to date, blowing out the market 70% to 26, 85 to 36 over the last year, and 5 years it is 210 to 92. And in fact, if we do compare it against Microsoft, Apple, and Google, I won't read all of these out, but you can see all these stocks have blown out the market. Second highest over the last 5 years. Only Apple beat it. over the last year, up 85% because of that massive drop off year to date as well. So in the short term, this stock has been an absolute killer, and even over the long term as well, it's easily beaten the market. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Check my Patreon, subscribe if you're not already, and I'll catch you guys next time.